today for another rendition of radioactive trading and show you how to avoid some of the problems that are out there with options trading and kind of turn them upside down. And gosh, bear with us a little bit. They've changed the GoToWebinar platform a little bit, and I'm still trying to get used to it. So sorry if we're stodgy or slow or anything at any points. Although today, you know, we've got kind of a brisk webinar planned for you. How's it going, Mike? You doing all right out there in Delaware?
Yeah, things are going well, Kurt. For those of you out in the audience, I just want to know real quick, can you hear Kurt speaking? This goes to part of the issue that he was talking about with the slightly new format. Kurt, I do show that you're active, but I don't show that your phone is green. So to me, it looks like you're not actually in the presentation, but I can hear you fine, and everyone is saying that they can hear you fine as well. So it looks like that's all set, but it's not coming up showing that you're actually logged in for some reason. But that's okay. We're all set, and everyone's hearing you, so we're good to go.
Groovy. Okay. All right. So, folks, I'm going to recommend that you make this fun along with us. We're going to do what we can. We're going to make this fun. This is going to be kind of neat. But the way to really participate fully is to participate in the polls and the prompts. So just now you participate to a prompt. You know, Mike prompted you to answer, and a lot of people wrote in. Thank you very much. And we're going to have some polls, and we'll probably start out with one. Let's see here. First of all, I want to tell you what to expect today. We're going to be talking about covered calls. We're going to be talking about their cousin, naked puts. It's nearly the same trade. It's just about the same trade. It's just the risk that you take on with a naked put is the same as the risk that you take on with a covered call. You just don't own the stock.
Mm-hmm.
We're going to talk about spread trades, and we're going to talk about the problems that's associated with these. And we're going to, along with talking about the problem, we're going to show a solution. Now, for you guys that like to do spread trades, we're going to show 2 riskless spread trades toward the end of the lesson. But just to let you know, that's not going to be the bulk of this lesson. The bulk of this lesson is going to be learning about structure and how to stay out of trouble in the first place. And I think you're going to really appreciate it. The structure that I begin with is a married put structure. And I'm going to use this time here to show you why I think, and I haven't been proven wrong yet, but why I think that married put plays are superior to covered calls for the kinds of things that the folks that play covered calls, what they're looking for. Okay, for the kinds of things that they're looking for, I think that the married put is actually superior, and I'm going to put up that argument. I'm going to defend it. Okay, it's superior to stock ownership, and it's superior to credit spreads. And again, it's all about structure. But before I get really into the depth of it, before I poll everyone, I want to brag on you, Mike, a little bit. Is that okay?
Okay, sir, if you must.
All right, if I must. During a 12-month period where Michael was playing this married put thing, you know, the radioactive trading method of married puts, it's different than a standard married put, isn't it, Mike?
That's right. What most of you have probably read, free information from your broker, of course, is just to establish a protective put position. They talk about buying stock and buying a put option where the put option is below the current stock price, out of the money, and only 1 month out in time, so the cost is cheap. But we all know the problems with cheap insurance, so we approach this slightly differently. We're going to take a look at that setup in just a little bit.
That's right. During a 12-month period, Mike had as his biggest loss doing the radioactive trading method, his biggest loss was 4.5% on the stock that he got into, which was Talisman Energy.
Yeah.
Now TLM actually fell by about 50%.
Yeah,
time period, right?
Yeah, it dropped from about $20 per share down about $11, about $10.80, something along those lines.
Okay, so that's kind of upside down. You see a lot of times people that have done covered calls, probably your ears are perking up right now, because sometimes when you're looking for the stocks that will pay the sexier premiums, right, they're also more volatile, and that means more risk. And so if you're holding on to a stock and it went down by 50%, you wouldn't expect to lose only 4.5%. You'd expect to pick up a small credit from doing your cover call, and then you'd expect to have a really big loss, a paper loss in the stock. It's not a real loss until we sell, right, Mike? I mean, that's what they say.
That's what they say, but yeah, in this case, if I was rolling down, if I was following the rules of a covered calls trade and I had been rolling down over that 5-month period, I would have reduced the risk from 50% down to about, it was about 12% off of that, so it would have been down to about 38%.
Yeah, okay, so you guys tell me, do we want a 4.5% loss or do we want a 38% loss? Now, here's the deal. Entering into the same kind of trade with roughly the same kind of capital, Mike, your biggest win that year, buying stock and also buying the put option and taking into consideration both the expense for the stock and the expense for the put option and the expense of any adjustments that you made, you cleared, pardon me, you cleared 59.8%.
That's right.
So very cool, okay? And you know, that's what we're talking about here is structure. The structure was so that if the stock fell, even if it fell by as much as 50%, you couldn't lose more than single digits.
Right.
On the other hand, if the stock takes off, you can do very well. So hopefully I've got everybody's attention, okay? You see, those stocks behave wildly, and we may be on the brink of some really wild action in the market. We don't know. We just don't know. But, Mike, you tamed these wild stocks with radioactive trading, and that's kind of exciting. Now, before we go on, what I'm going to do is set up a poll here because I really want to know from our audience what kinds of things you're doing now. Okay. So I'm going to put up there some options to choose from to see what kinds of plays you're doing now, and if you would please. Consider everything that's up there and answer everything that applies. For example, you might be trading cover calls and doing credit spreads, or you might be doing long calls and puts, but right now you're in cash, so you're not trading options at all right now. You know, that's the idea. And that poll has been up there for only 30 seconds. We've got more than half of the audience has already responded. Thanks so much, guys, for being so responsive. It's going to help Mike and me to really tailor this presentation and you know, not stay on really basic terms if you're, you know, ahead of the game. And we're not going to, you know, talk over your heads if you need some help, you know. So anyway, all right, good. That's been a minute, and we've got most of our votes in. I'm going to go ahead and close it there and share. Mike, we've got about 3/4 of the room is doing cover calls or naked puts.
Okay. That doesn't surprise me based on the title of the email reminder that you sent out today.
That's right, yep. We're going to do a follow-on poll for everyone, one follow-on poll for everyone, and one follow-on poll for just the cover call players, and that's 75% of the room, or 72% of the room. So, okay, 44% are doing long calls and puts, 54% are doing the spreads, and a small minority, 5%, are not trading options at all. Folks, if you're looking into options, and this is your baptism, okay? I mean, if this is you just getting started, I think you're in just the right place, because I wrote my book, The Blueprint, after losing everything and finding out from the world's best traders how to never let that happen again. And what we do here is hyper-conservative. I think it's very important for you to be starting here. So good for you. Okay, let me hide that, and I'm just going to ask a real honest, simple question, a follow-on question to first the whole audience, and then just later on we'll ask another poll specifically geared to only folks that are doing cover calls consistently for 2 years or more, okay? But this is for everyone. I'd like for everyone to participate in this poll here. Are you happy with your 12-month performance? This is shaping up, well, actually it's shaping up a little better than sometimes we see. Right? That's it's kind of good. The first two lines usually add up to what?
Well, the first two lines, those that are happy or they've exceeded their trading results or they're making money but not enough, we usually see that amount to a total of 20% of our voting
Right.
audience on average. And we've almost doubled that. We have so far.
Yeah. It's continually changing. But all right, folks. So thanks so much for your participation. A moment ago it said 75% have voted, but now it says 73% have voted. I suspect it's because more people have come in the room. We're talking to over 50 across the United States and in other countries. 58 exactly. Okay, let me go ahead and close this poll right now and share the results. And this is actually kind of encouraging. 10% have exceeded their profit expectations, which usually we see that as a pretty low number. But, you know, the first two numbers usually add up to about 20%. Right now they're adding up to 48%. So just less than half of the audience is doing well. They're making money. So that's encouraging. The reason that's encouraging is usually it's a 20-80 split, right?
That's right, yes.
Starting with the third line, 43% have mixed emotions. They see potential, but need to change their game. 10% lost money last year, and not just lost, but lost and they said, ouch, right? But I'm encouraged by this also. Nobody said that they were discouraged enough that they wanted to quit. So that's pretty cool. Okay. Mike, I'm going to hold and reserve that covered call poll here for just a minute, okay? And we're just going to talk about the difference between the covered call and the Mary put or protected put. Now, these two trades are similar in structure. I mean, they look the same, only upside down, right?
Well, yes, and what you mean by they look similar is that in both positions we have to buy stock. And if the stock was representing 97, 98%, 95% of the capital invested in the position, then naturally both positions are going to be bullish, aren't they, Kurt?
Right, yeah. It's bullish because the majority of what we're doing is a stock purchase. Now, with covered call, we hedge it. We hedge our stock purchase with a short call. And I don't agree with this. This is by the way, the images that I'm showing up here are used without permission, but they're being used. You can see this on Options Express, okay, and you can see similar things in all kinds of brokers' sites, okay. I don't agree with this. I don't agree that the risk is safer. Mike, you've got a family that you love and care about. Would you recommend, after 10 years of being the options education supervisor over there at Power Options, would you recommend to your closest family that they do covered calls as a very safe investment?
No, and especially not with the bulk of their investing capital. As over time, this recipe here, which it's showing safer, and maybe it's slightly safer than owning stock, but long term, you're still taking on 97 or 95% of the risk of owning the stock outright, and that can pose a problem. Even if you're using stop orders, eventually you're going to suffer losses. You're going to have those sudden, unexpected declines, those black swan events on the stock itself or just across the market, where you're suddenly down 30, 40, maybe even 50% on your position.
Right. You know, this safer icon here, I think maybe it should belong kind of in the middle. You know, with just owning stock being right in the middle, I think maybe just a little bit to the side of that is where, a little bit to the left where it makes it a little bit safer, okay? Whereas a protected put, also you own stock, but instead of taking a short position, selling a call, which is bearish, all right? Instead of doing that, you're taking a taking a long position on a put, okay, which is also a little bit bearish, okay? But guess what? It's net bullish, and this safer really does apply. Okay?
That's right.
Well, just look. Okay, we've got a precipitous fall here, right, that you could have. Over here, you've got a floor. What's interesting, though, is over here on the cover call, you've got a ceiling. The reward for doing a cover call, the reward for hedging your stock with a short call is that you end up limiting your upside potential. Whereas if you hedge your stock with a protected put, you don't limit your upside potential. Okay, and that's really important to see. Now, why do you figure a whole lot of college-educated people, including myself, have been, convinced that the covered call is the better play?
All right, well, I can think of 3 reasons off the top of my head. Now, the first reason is just basically what was allowed. Initially, if even up to 5 years ago, Kurt, if you went to your broker and you applied to trade options, level 1 trading allowed you just to trade covered calls. You were only allowed to sell calls against the stock you owned until you got more experience, and then you could apply for level 2, level 3, and level 4. Thankfully, a lot of that's changed. Level 1 now usually includes selling covered calls, then buying calls and buying puts in most places. Sometimes even spread positions are allowed. Number 2, well, in addition to only being the only thing you're allowed to do, it is the most highly touted because people who are trying to sell you something, for example, sell you a $1,500 or $2,000 weekend seminar, are going to sell to the largest group. And the largest group, of course, since most people were only allowed to trade covered calls, was advocating the covered calls trade. And 3, it kind of sounds sexy, doesn't it?
It does.
It sounds like real estate. I'm buying stock and I'm going to sell it. I'm going to rent it out month by month. I'm going to be able to generate 3 to 6% per month in theory. And if I do 6% per month over the course of the year, that's a 100% return. Who doesn't want to do that?
Yeah, who wouldn't want to do that? And then, honestly, Mike, I bought into that, and I really related to the real estate analogy. Like, hey, the stock is my house, and I'm renting out my house by selling calls month after month. But the thing is, I've done some real estate investing, and I know the biggest landowner in Teller County, good friend, and used to work for him at one point. He owns 450 houses. Not one of those homes is uninsured. In fact, I don't think that's even legal. I think you have to have insurance. But here's the point. If you're going to trade covered calls, where's your insurance? Buying insurance is not sexy, and selling, getting a premium is sexy. And I think that's why we've labored under this misconception for so long. Also, Mike, you said a weekend could cost $1,500 or $2,000.
Yeah.
Check this. In 1998, when I went to my weekend seminar, the price tag was $3,500. I think a lot of folks on the line maybe have done that too. Spent more than $15 or
Sure.
The same outlook, has the same quote unquote same riskiness rating, but they have very different possible outcomes. And that's what it starts from. Okay, but let's go ahead and talk about covered calls, and then we're going to poll the audience, but only the audience members that have consistently done covered calls for 2 years or more.
Okay.
Here's what, by the way, I'm taking this right off of the most popular site. This verbiage isn't made up. Consistently generated every month regardless of market direction, and it can be used to live on for retirement or reinvested dramatically to compound the value of a portfolio. This is straight off of the biggest and most well-known website that promotes these weekend seminars with a $3,000 price tag. Okay, this is what it means: 40% year over year. So if you start with $100,000, okay, and at the low end, if it's 3% per month, if you compound that monthly, it's not 36%; it's 40%.
Right.
Okay. All right. Now, 6% per month compounded doesn't add up to 72%. It adds up to 100. And so, mathematically, if you do 6% per month, you start with $100,000. At the end of 12 months, you have $200,000 to withdraw. That's what you have. Okay. All right. And if you did that for a 3-month period, you'd have $400,000 to withdraw, or a 300% increase. Get that? You start with 100,000, and then you have 400,000 to withdraw at the end of 2 years. Okay, so now, having said what the math really means, okay, what I'd like to do is do another poll here, and that poll is going to Jerry Maguire it, okay? We're gonna see how folks are really doing with the covered call trading strategy. Now, if you do more than trading covered calls, I want you to only consider the portion of your portfolio that you trade covered calls with, okay? And only if you've been doing it for more than 2 years, 2 years or more. Okay, so after 2 years, I have had a 100% to 300% gain. That's what it would be with 3%. 100% would be the return after 24 months at 3%.
Mm-hmm.
And a 300% gain is what it would be after 2 years with 6% per month. Okay. All right. So far, no takers in the first line. And I really invite you, please, God, tell us, because I haven't seen this animal in 12 years, okay? And Mike, neither of you, and you've been the director of options trading, options education.
Mm-hmm.
Over at Power Options, you deal with thousands of subscribers to one of the more popular options trading services. Okay, let me close this and share the results. Okay, if there are folks making 3% a month, they're not in this room. Okay, we've got 67 online now. Okay, we had 58 a few minutes ago. We've got 67 people online. Not one is doing this 3% per month deal.
Okay.
Certainly no one's doing 6% per month.
Right.
But more than half did say after 2 years I am ahead, but not by much. Not by that much. Okay, now I'll tell you why. Here's, write this down, Mike. This is incredible wisdom. Are you ready?
Ready.
Everyone's a genius in a bull market.
That's true.
Okay, that's it. And folks that were doing the cover calls during 2008 got hurt. Okay, they got hurt. 30% after 2 years say, I have about the same. So after 2 years of doing the stuff that we learned in the seminar on the weekend, that cost us $3,000, okay, we're about where we started, okay, and then 15% said, after 2 years, I wonder why, but I've lost money. Well, we're getting ready to show exactly why, and not just show the problem. It's important to identify the problem, right? But after we identify the problem, it's more important to show the solution, okay, and that's exactly what we're going to do. Okay, so Mike, that was a little bit disheartening, I know, but it's about what I expected. A real quick thing for the credit spread traders, okay? Mike, this is a credit spread. What we're doing is selling two 67.50 calls and buying two $70 calls, and generating a credit of 50 cents per spread, or $100 total. Now, guys, this is not the solution, okay? I'm just identifying a different problem. What's the problem with the credit spread idea here?
Well, the object is that we're neutral to bearish on a stock. We feel the stock would be trading below that lower strike price at 67.5. If that's the case at expiration, both of our options expire worthless. We keep the net credit of $100. We make that full 100%. It's a 25% gain off of the capital we'd have to have on hold, that $400, in order to place this trade. The risk is if the stock goes up, we're going to hit the maximum loss for our position.
Right. Now, I don't have any problem with credit spreads in principle, in general, because I do know that you limit how much you could possibly lose.
Mm-hmm.
But this particular credit spread, you would have to be right more than 4 times out of 5. Okay, you'd have to be right more than 4 times out of 5, because if you're right 4 times, then you'd make 100, make 100 again, make 100 again, make 100 a 4th time. Okay, and then if you were wrong, then you'd lose 400. Okay, so you lose, make 100, make 100, make 100, make 100. You've got $400, and then you lose it all on the 5th bad trade. Okay, so you'd have to be, well, gosh, you'd have to be 90% accurate, or at least 81% accurate, right? In order to make money with this long term. And so so that is another problem. Later on, we're going to identify how to take out all the risk. Did you hear that?
Yes.
All the risk out of a bear call spread. Okay? All right. So what is your problem? I mean, as far, we just had a bunch of folks say that they have lost money, okay? And, and 55% have made money, but 30% have either, 30% has about the same. So they haven't lost money, but they've lost something more infinitely valuable. They've lost time.
Right.
they haven't gotten anywhere and spent 2 years doing it, okay? And then 15% are behind the curve. So, what's the problem, all right? What's the problem? Well, if I could solve only one of these problems for you, what do you think it should be, okay? I'm not going to tell you what I think it should be. I want you to tell me what you think it should be. Okay, folks, we've had really good participation so far, but this one's a little slow coming in. I guess maybe because you're reading through, right? Yeah, that makes sense. I guess I shouldn't be impatient. You're reading through, and of course we want to make sure that we answer the one thing that we want out of the 4 available solutions. Starting to shape up like I expected, Mike. Of course, when you do this every, 2 times a week, you do this 100 times a year for 4 or 5 years, you kind of get used to what folks are going to say. We've had different crowds. We've had different crowds, but this is about what I figured. Okay, let me go ahead and close because we've got a very goodly amount of our votes in, and it's been 1 minute. So, all right, let me share the results. Okay, 21% say, I'm not good at picking stocks, make me a wizard. 9% I stink at timing trades, make me a prophet. Well, guess what? For 30% of you, I don't have the solution. Okay, for the 21 and for the 9, I don't have the solution. I can't make you a wizard, I can't make you a prophet, because I am no wizard and no prophet myself. I pick stocks less than half the time. I pick good ones. Okay, I think my record is like 46 or 47% winners. Now that sounds a little bit weird. Some folks might want to hang up the phone right now. But the thing is, I make more money on my winning stocks than I lose on the losers. Does that make sense?
Yes.
All right. And if you lose nickels but you make dimes, you can afford to be right only half the time. We're going to show a little bit later on how if you're right only half the time, you can make good money. Okay? All right, but for the 21% that say, I just want to make a little more when I'm right, guess what? I've got a solution for you. And for the 50% that say, geez, Kurt, I just want to not get hurt badly when I'm wrong, well, guess what? I've got the solution for you too. Okay? So for 71% of you, I know that I can help. All right? And probably actually more than 71%. Okay, so let's go ahead. Why hasn't the problem been solved yet? Well, the reason the problem hasn't been solved yet is that we have not looked at, we've been looking at the wrong things. We've been looking at how to pick stocks. We've been looking at how to time trades, and what we should have been looking at is structure. And so for me to really lay this out, okay, we're going to have to look at something that fails first, and then we're going to look at something that succeeds. Okay? So, and then when we begin from a structure, a position of strength where we can't lose, okay, or lose much, from that position, any move can be advantageous, okay? And we're going to be talking about the riskless spread trades a little bit later on. Radioactive trading has 11 different ways to take money out of a married put play without necessarily selling the stock. We're going to show maybe two today, okay? All right, but first I want to show just the structure. We talked about 2-year trades in a 12-month period there, Mike. Your biggest loser and your biggest winner, right?
That's right. Talisman and then SLW.
Right. So you lost 4.5% on your biggest loss. Your biggest loss was only single digits. It was 4.5%. And you had losses, but you tamed them. You kept them down. And your biggest win was 59.8. Well, I'm going to show, in order to illustrate that it's not about picking stocks and it's not about timing trades, I'm going to illustrate that by showing what happened to me and what happened to others during a 12-month period that would have played Altera twice. I played Altera twice, made money once, lost money the other time, but I ended up with a net gain. Okay? So I played Altera twice. The first time, I made 12%. Now, the stock went up 17.3, and everybody's saying, oh, you spent so much on the put, that's why. Well, yeah, but I made 12%. Mike, is that more than 3 to 6% like a covered call player might get if they had a winning?
Oh yeah, the gain was not capped, so if we were in that stock as a covered call position, we might have decided to get assigned at our 3 or 4%. If we wanted to stay in it, we would have had to put more money into the position, so we wouldn't have gained that 17%, we wouldn't have gained that 12%, we might have been closer to 6% or 7%.
Right. See, Altera went up 17.3%, but I only made 12. But so what? If I'd have sold a covered call, I would have only made 3 or only made 6, right? Okay. Now, here's what happened. The second time, I lost 5.6%, but the stock dove. It plummeted. It went down by 21.8%. Guess what? It kept going down after that. It went down to 31%. But even so, even if I had held on and been hopeful during that time, my loss still would have been capped. My loss still would have been only 5.6%, okay? And so that is the structure that I'm talking about. I'll go ahead and show the structure, how it's done. But, Mike, 12% win and followed by a 5.6% loss, and it's about the same amount of capital. Am I ahead?
Well, looking at those numbers, you're going to be ahead. That's right.
Okay, but if I had played the stock only, I would have made 17.3 the first play, and I would have lost 21.8 the second play. So would I have made money there?
No, you would have been behind.
What about a covered call? If I had done a covered call here, I would have made maybe 6%, right? And then I would have lost maybe 15.8%. Wait a minute. Does making 6% on the way up and losing 15.8% on the way down, does that make up? Does that...
That's actually going to be a larger loss, isn't it, Kurt?
It would be a larger loss than if I just played the stock. And I received premium both times. How about that? Okay? All right, so here's the structure that I've been yawing about. Okay, let me go ahead and show you. The structure is that you purchase a stock, and then on top of that, you also pick up a put option that's 6 months away in time or so. It could be more. 5 months is usually the limit to what I'll do, okay? And it's not because I intend to hold it for 5 or 6 months. It's because the best price for the money is, the best value for the money is what's available there. So you buy a put option that's in the money and far out in time. Now, that does add to your cost basis, right?
Oh, of course, yes. We're going to be adding to our out-of-pocket capital.
Right. It's going to add to the cost basis, sure enough, okay? But it does give me a guaranteed exit. So for the next 6 months, no matter what shenanigans go on with Altera, no matter what does happen to it, the most that I risk is the difference between what I've invested, okay, and the strike price of the put. The put gives me the privilege to sell at 29, not the obligation, but the privilege, okay? If the stock's at $45 a share, will I exercise that privilege? Probably not. I probably don't want to sell it at 29 if I could get 45 on the open market, okay? But on the other hand, if the stock is trading at $3 a share, will I use that? Sell for 29 bucks a share? You betcha, okay? So the amount at risk is really the difference between what I've invested and my insurance policy here. And this is pretty much my deductible or my copay or whatever it is. It's $1.85. $1.85 out of this $30.85 is all that's at risk, or about 6%. Now, before we go much further, I'm going to explain something. This is 100 shares in one put, right?
Yes.
Mike, if I picked up 500 shares in 5 puts, would it be 30% at risk, or would it still be 6?
No, it's still only 6%. Your invested capital would be in the range of, $15,000, $16,000, and you're going to be risking about $985. So it still comes out to about 6% of your total capital invested. Right.
Here's what I did, in fact, do. I did, in fact, buy 500 shares and 5 put options. And so my capital risk, my actual capital risk was only about 1%, okay? And here's why. $925 is what's at risk, and my account was just over 100,000. It was like 110,000
Right.
at the time that I did this play. Okay, so out of the 100,000, I could only lose about 1%, and out of the 15,425. Out of the 15,425 that I've got in, I could lose as much as 6%, 925. Okay, does that make sense? All right, now I'm doing this for the benefit of our audience. I'm going to say, if you limited risk like what we showed, okay, 6% of the trade and 1% or less of your portfolio, what do you think your results would have been last year? Let's just look over your last year and think about the losses that you took. You don't have to get out a calculator, okay? But think about the losses that you took, and if those losses were cut down to 6% or 1% of your total portfolio, and your gains, well, I think I've already showed that you could possibly gain more with a win on a Mary put than you would gain on a covered call play, right? But even just limiting the losses, okay, let's not even go there with the with the hey, you could have made more. Okay, let's just limit the losses only and see if that makes a difference in what you think your account would have done. Now, Mike, it's been almost a minute. I'm going to leave that up there for another 5 seconds. I invite folks. I haven't had anybody say they've done worse under that plan.
Right.
So if you really think that, please vote, okay? And if you would have had no change, please vote. We're at 73 attendees right now. And I still haven't had anybody take the bait. Okay, let me go ahead and close and share the results, okay? Now, this appears to add up to 99%. It's because of rounding, okay?
Right.
But the 30%, 3 out of 10, would have still lost, but they would have lost much less, okay? So is their account improved?
Yes, they have more capital remaining in their account to continue trading or to invest in new positions.
Check this out. This is a bigger answer. I lost overall last year, but I would have won if I had done that. I would have taken a negative and turned into a positive. I lost overall last year, but would have won if I had done that, 39%. Wow. And then 3 out of 10, 30% would have said, I'm very happy with my trading. Well, let's see what it was before. Wasn't it 10% today?
10% or 11% were very happy with their trading, and we had 38%, I'm sorry, were making money, but not enough.
Right, okay, and the rest, need to change my game or lost money enough that it's just bad news, okay? Nobody says they're ready to quit, and that's good, okay? All right, so just having said that, just having shown the limiting risk, okay, let me do this one again. I haven't shown any of the really sexy stuff, okay? But just having shown this, nobody said I would have done worse. Nobody said no change. Everybody said, you know what, my account would have been improved if I'd have just employed that structure. Wow, cool. Okay, so let's compare the results, okay? Stock only, I look at Altair, and it has great fundamentals, okay? Stock only, I look at the chart, and it suggests further upside. I invest once, and I make 17.3. I look again, and it's still got the great fundamentals, and it does another chart pattern that looks like it's going to go up, and guess what? I'm wrong. So this time I lose 21%. If I'm right half the time, Mike, with just the stock, I lose $1,000. I actually worked it out with the picking up 500 shares and then selling. I would have lost $1,000. Okay. However, this is what I did do. I used radioactive trading. Altair had great fundamentals. Altair's chart appeared to suggest further upside. Sound familiar? All right. Well, I invested once and made 12%. Okay. Invested a second time, and I lost 5.6%. And guess what? I was only right half the time again. All right? Only right half the time, but I made nearly $1,000 between both of those transactions. Okay? I actually made $1,836 after commissions on the first play, and on the second play I lost about $900. So it's like $936 is what I made between the two plays. Okay, here. So this is the deal. Okay, on the way up, the guys playing married puts make money, and the guys playing just the stock to make money. On the way down, the guys that are risking too much, by just owning the stock, get hurt. Okay, folks that are selling a naked put right here get hurt. They get really hurt, don't they?
Right, of course.
Yeah. So going up this way, if we had bought in September and sold an October or November covered call, Mike, how much could we make, even if it's out of the money?
Oh, well, you're looking at that 5-6%, right, Kurt?
Right, 5-6%.
Okay. 4 or 5, really.
Yeah, but we doubled that. We more than doubled that. Okay, and on the way down, what could I have lost? Could have lost 20, could have lost 30%, but guess what? Didn't. Okay, so the radioactive profit machine, the Mary put, only lost 5.6%. Okay,
Mm-hmm.
So the person that sold me the puts won the first time, right? Because those puts ended up worthless, but the naked put seller ended up on the hook later. You see, I was buying those puts for about $3.50. Okay, now if it's for example, that second time, if it's a $50 put, a $50 put that I pick up for $3.50. What's that put going to be counting against him when the stock is trading at $32 a share?
Well, it's going to be, maybe 2 or 3% off of that, right? It's going to be a 28% loss or so.
Yes, it's $18 is what that guy's going to have to.
Monetarily, yeah.
Yeah, not cool. Okay, so the person that sold me the puts won once, but he ended up on the hook later. Now, at the time that I wrote this, Altera was still at 32. I don't know if it's recovered or not, but point is, I didn't get hurt. Okay, and a lot of folks will look at that and say, "Well, Kurt, come on, I'm not going to hold on to a stock when it's falling. I'm better than that. I'm going to have a stop order in place." And the stop order doesn't cost anything. The Mary put costs something, but the stop order doesn't cost anything. Well, Mike, let's go back in time here. May 6, 2010. What are you doing?
Well, I'm doing a coaching session, Kurt, with one of the Power Options customers, and as we're talking, a lot of bells and whistles start going off in the background. A lot of his spread trades are getting filled and closed and hitting their maximum loss, hitting their trigger points. So in a panic, he has to get off the phone and go start managing some of his bull put credits, his iron condors, and especially his iron butterfly trades. And I calmly said, well, I understand. Go ahead, take care of your trades, and then reschedule the session for a time that's more convenient. And he paused for a moment. And he says, well, don't you have to go? Don't you have to adjust your trades? The market just dropped, 500 points. And I knew exactly where I was with all the positions in my account. A couple of my positions, the radioactive positions, were bulletproof. Some of them only had a risk of about 1 or 0.5%. So even if this was a catastrophic event that was going to stay and was going to remain, I knew in some positions I was guaranteed a profit. Others I was only going to lose 1% of what I had invested.
That's right. What's really exciting, the bulletproofing. What's really exciting about bulletproofing is that you know that you can't get hurt. You
Right.
still have unlimited upside potential, but you cannot get hurt. And my mother called me on May 6, 2010. By the way, that's the flash crash. If that's going over some folks' head, the Dow dropped 1,000 points in about 15 minutes.
Mm-hmm.
Okay, but to add insult to injury, the stocks came back up to almost the same level the same day. And so a lot of folks got hurt by those stop orders. My mother called me, and she says, oh, honey, something's going on in the stock market, and I know that you do something with that. Are you okay? And she woke me up from a nap, and I told her, Mom, it's okay. Thanks for calling. Thanks for being concerned. Everything's fine. I'm bulletproof. She says, you're going to have to explain that bulletproofing thing to me again. So here's the deal. If we were into Digital River, Mike, Digital River had great fundamentals. It had just made a double bottom stock pattern, and I picked it up. I bought stock and also bought a put option. Following day, bad news. The stock actually fell. Over 30% is where it opened, and look at this volume, okay? In
Right.
that volume, it actually started going down from there, down from the 35% mark. Now, if I had a little 6% stop loss order in place there, would I have gotten hurt?
Yes.
Yeah. And I also would have had to been psychic to get out at the same deal because, look, I got in at about $40, okay? Well, here, Israel River's trading again at $40 on one day about a year later.
Yeah.
So if I wanted to get out without a loss, I'd have to be very psychic. I'd have to pick this day out in the future, more than a year away, and sit on the stock during that time. But that's not what happened. What happened was I took a 5.7% loss and moved on. It was a 5.7% loss for me. Everybody that got in at $40, they got out at a 30 or worse percent loss.
Yeah, and if you had a bull call debit spread or a bull put credit spread, in an instant you would have hit 100% loss on that position.
Right. So how do we structure things so that we have unlimited upside and low risk? Well, we already showed it. Okay, we already showed where you pick up the stock, also a put option that's far away in time. Okay, and that makes for a total investment of $30.85 in this case, but a guaranteed exit of $29 in case something goes horribly wrong. So the difference is all that I have at risk. Now, when I showed this to you about 5 years ago, 4.5 years ago, Mike, you had one objection. What was your objection?
Well, it's the same objection most people see when they first look at this, and many of our people, many of our attendees, excuse me, online may be looking at this. Well, you know, my first response was, I appreciate that you're limiting risk, Kurt, but why are you adding so much cost into this position? I mean, if you're buying a stock at $27.35, you're paying $3.50 for the put, you're adding over 15% of cost into the position. You're not going to realize a dime until the stock goes up to $30.95.
Right. And, of course, my reply to you was, oh, really? Why don't you come to one of my free webinars? I'll show you exactly how I make money with this. And I think you're glad that you came to that webinar.
I am.
Yeah, because, I mean, I don't think that the SLW trade with 59.8% return, I don't think that would have happened otherwise. But more importantly, I don't think Talisman Energy, you would have been as protected otherwise.
Right.
So, here's the deal. A lot of folks look at that $30.85 for the stock and the put, and they think that the stock has to go to $30.95 for me to make any money. Well, let's talk about that. Okay, first of all, what you have spent for both your stock and your put is represented here by this break-even line. And this is the graph of how expiration Friday is going to look in 6 months, 6 months distant, okay?
Right.
So again, all that we have at risk is the difference between the strike price, right? The strike price is represented by this line down here, $29, and the, what do you call it, the break-even.
Break-even.
Yeah, which is my initial investment, okay, of stock plus a put. Now, this is the case on expiration Friday. However, who says, first of all, that I'm going to necessarily hold for 6 whole months all the way up to expiration Friday? Nobody said that. Am I obligated to?
No.
No, I have options. So I'm not in control of what the stock will do, but I am in control of whether or not I will hold it for the whole 6 months or I'll get out earlier, and I'm likely, even if the stock is down, I'm likely to get out at a less than 6% risk because the stock is going to be worth something, but that put is going to be worth more than just the intrinsic value. There's going to be time left, right? Now, the second thing is, here's another thing I'm in control of. I'm in control of whether or not to do income methods. The income methods take income while I'm holding the stock in the put, and while I'm taking income that way, it reduces the gap between the break-even and the, what do you call it, the strike price of the put. It makes it so that I could lose less.
That's right.
What would you say if I told you this whole thing was bulletproof, meaning that those lines swap places? What I had spent was less than the strike price of the put where I could get out. What if you would say, what if I would say that this whole thing was bulletproof way before the stock ever got to $30.85? Would that take away the whole put objection, do you think?
I believe so. I think it would be.
Well, this is what happened when stocks go up. When stocks go up, puts come down, right? Most of the time. I've seen some rare occasions where the puts actually go up too. for example, Amazon. I got into Amazon. I bought the stock, also bought a put option, and then they announced the Kindle, and so that put a lot of uncertainty into the stock because the Kindle hadn't yet been released. And so the stock went up on anticipation, and the put also went up because of volatility. Interesting. Okay, but usually when the stock goes up, puts come down, but they all come down, don't they?
That's right. Everything's going to come down in price as the stock moves up.
Right. So here's the deal. Altera did not go to 30.85. Altera went to 29.40, well below that break-even of 30.85. And I was able to take a credit and leave the upside open. Now, I did this two different ways. I'm going to only show one, okay? I'm going to only show one. Income method number 3, which I also call the bulletproof vest. The March $29 put option had been selling for $3.50, right?
Right.
And now it's selling for only $27.52. Okay. Now this is March of the following year. The November put option was obviously trading for less, right? Obviously, why? Because there's less time till expiration. And even though it was actually $1 higher, because it's, I did this on October 15th, right?
Yes.
The November puts were trading for just $1.62, okay, because it's only a few weeks away. It's like, October 15th, it was about 4 weeks away from expiration, okay? I did this because Altera was getting ready to have an earnings announcement. But look at this difference here, Mike. I'm taking the 252, swapping it for another put that costs $1.62, and so I take a credit of 90 cents.
Yeah, you're going to reduce your cost basis in the position by 90 cents, yes.
Yes, and I also, because that's a new put option, I raised the payout by $1. Do you remember what was at risk, the difference between the $30.85 and the $29 put option?
Yeah, we were at $1.85 or 6% of your total investment at the time.
Yeah, $1.85 at risk. Now, guess what? I just took a credit of 90 cents, and I raised my payout by $1, so that's $1.90. Guess what I am? I'm bulletproof. I call this the bulletproof vest.
Yeah, you have no risk on the position. Your guaranteed payout is higher than your total cost basis of the stock plus the put.
Yep. And I've had people say to me, oh, well, Kurt, you lost on the put. You bought the stock, but you lost on the put. Oh, really? Let's take a look at this. This is what the put cost to buy. It was $3.50. The initial March $29 put option cost $3.50. Gosh, got to get my decimal points right here. Okay, $3.50. And when I sold it for only $2.52. So it does look like a loss, doesn't it? But let me remind you that this intrinsic value here is how much more that put strike price was above the stock's present trading price. For example, it was trading at $27.35.
Yes.
Okay. So this $1.65 of intrinsic value is what brings our value up to $29. Okay. Now, as the stock goes up, the put's value comes down, but the intrinsic value goes first. And as that intrinsic value goes away, it can only be because I'm gaining value in the stock, right?
That's right, Kurt.
Every dollar I lose out of this column goes into a column that's not shown, and that is the column of, hey,
stock
I own
ownership.
the stock.
Stock ownership, yeah.
I own the stock. So if it goes down $1, it's because the stock went up $1. So there's no loss, no net loss. If the stock goes up $1.65, this is going to disappear. Okay? And it did. But the time value has actually swollen up. The full price for the put is, it was $3.50 and now it's $2.52. So it's lost 98 cents. Okay? But for that to happen, the stock had to go up by $2, so I don't care. Look what happened to the puts price.
The time value itself, the extrinsic value itself is what we're looking at now.
Right. The extrinsic value only, the time value, had been $1.85. It was just a component, okay, of the puts pricing before. Now, it's all time value. There's no more intrinsic value. That's okay because my stock went up. And I'm going to take this swelling of the time value and utilize it. That's what income method 3 is about. There's also income method 4, income method 9 that manipulate the put, but we're just going to show 3. Okay. Now the cost basis of the stock and the put had originally been $30.85, right?
Yes, that was our total investment into the position.
Okay. I took a credit by selling one put and buying a lower priced put that's closer in. Now remember, I never said I wanted to hold all the way till March of the next year. I wanted to make this a short-term trade, but I bought it far out in time.
Yes.
Because of this pricing phenomenon. The new cost basis for owning a stock and a put is $29.95. See that?
Yes, you lowered it by that $90 exchange from swapping the puts, or $90, 90 cent, excuse me, Kurt. So now you've got a total investment. Your total out-of-pocket in this position is $29.95, but in the worst-case scenario, you're guaranteed to get $30 back.
Right. And so if my cost basis is $29.95 and I'm guaranteed at least $30, am I obligated to sell at $30?
No.
No. So my at-risk amount is a negative nickel. It's a negative 5 cents. The worst that could possibly happen is that the stock crashes at that earnings announcement. The earnings announcement happens, I think it was November 4th or something. Okay. That earnings announcement was going to be a determining factor whether the stock went up or down. But look, if it goes down, so what? If it goes up, I make more money. Okay? So negative risk means bulletproof, and that's where we were. Now, this is done just before an earnings announcement, okay? And the play ended up returning the 12% that I showed, okay, with no more than 6% of my capital ever being at risk, and for about 3 weeks that I was in the play, no risk. There are other income methods that I did during that time, but we don't have the time to show it. Also, some of it needs to be, we need to charge for some of our stuff. But Mike, reducing the gap to less than 0, making ourselves bulletproof. Were you pretty happy to be bulletproof on May 6, 2010 when the flash crash happened?
Absolutely.
Yeah.
I would have been okay having only 5 or 6% risk had I just opened up a new position.
Yeah.
And also, oh, go ahead, Kurt.
Oh, I was going to say, but you had like 1%, 2% risk in some of your radioactive profit machines that you had already done an income method or 2 on.
Right.
You're completely bulletproof on the ones that you had collected enough premium to bulletproof. So you had no risk.
And even, I was just going to say, even if I hadn't, even if I did have a new position that had our 6 or 7% risk that we're talking about, and the market crashed as it did on May 6th, guess what? I'm still in control. I don't have to close the stock, so when I turn around, blink my eyes, and it was just a glitch, and the market kind of comes back to where it was a little bit later, I'm still in the position where I was, with the protective put in place, is still looking to do income methods. If I had a stop loss, I would have been filled instantaneously for a loss bigger than what I'd originally said at 7 or 8%. I would have been filled at the worst possible price and been out of the position, then tried to scramble to buy it back when it was back at the price it was before that event took place.
Yeah, it like I say, it tames the bucking bronco that the market is. You tame the market and tame your own emotions, which is even more important.
Yeah, because this is, this is the opposite of day trading in a sense, Kurt. And a lot of people, I've seen a lot of people get into trouble with just something as simple as covered calls because they fear that they have to sit there, or they have to not sit there, and if the stock moves down 5%, they have to roll their call right away, then it goes back up 3% 2 days later, so they've got to roll back to the original price, then it drops 7% in the next 5 days, so they've got to roll down to the new price, and then it goes back up. Well, they can't get assigned at the lower price, so now they have to move back in, where if they would have just left the position alone, they may have been okay, knowing still that they're risking that position, but we don't do that. We try not to do that with this technique.
Go through any of those emotional gymnastics or frantic mouse clicking,
Panic adjustments, right?
It's kind of as boring as watching paint dry. Either you're making money or you're not. But if you're losing money, it's single-digit percents, very manageable.
Yes.
And if you're making money, there's no limit to the upside. Mike, I just put out a poll there and said, what do you think of spread trades? that take income, risk nothing if they go against, and still leave the upside open. That's essentially what I did here with thinking method 3. Well, let me go ahead and close that poll, share the results. 45%, and you could have answered in more than one of these categories, and that's why the total is more than 100%. 45% say, man, that beats the shit. Taki mushrooms at a covered call. 10% say, hey, can I do that in my IRA? Absolutely. What I just showed you can be done in an IRA. 55% say, whoa, I didn't know that you could do that. You got any more? Well, yeah, I do. In fact, I got 10 more. I'm going to show one, okay, if we have time. Where are we on the
102.
Yeah. We usually like to finish by quarter after the hour. I'll just, guys prompt me, go ahead and send it. Would you like to see another riskless spread trade, one that still leaves the upside open but takes income right now? Would you like to see another sample? And if so, then I'll go ahead and run that. If not, I'll go ahead and I'll just show you where you can pick up the blueprint, and we'll be done for the day. What are folks saying there, Mike?
Rich says, yes, please. Pierre, yes. Pierre unfortunately missed part of our presentation as he lost internet connection, but we are recording this webinar, and it will probably replace an existing webinar later on this afternoon in the webinar archive.
Yes, that's a good idea. Let's make sure that Pierre has the ability to get back to this. And folks, yeah, because we're recording this, it's likely going to be made into a product that we'll charge for. But you can see it for limited time for free on RadioActiveTrading.com. So a lot of folks are saying yes, yes, yes. Okay, I've got a lot of yeses. So let's go ahead and do that. Mike, first off, is my screen showing? Did it close the poll?
Yeah, you've closed the poll. We've got the Humana trade up there with another 6.7% maximum risk.
Right. Yeah, this is a dated trade. This is not day trade, but a dated trade. This is from 2011. But I'm showing Humana shares at 63.90. The $65 put, see, that's in the money, meaning that the put option is higher strike price than the stock. Okay. So it's part intrinsic value and part time value. Okay, so it gives us a total invested amount of $69.70, but a guaranteed exit because of that strike price of $65. So the amount at risk is $4.70, and when you set that $4.70 against the $69.70 it takes to get into this, it's around 6% again. In this case, 6.7. Okay, now remember that this is scalable. With my Altera trade, I didn't pick up 100 shares in one put. I picked up 500 shares in 5 puts. Okay. Now, in the case of somebody with a $100,000 portfolio, check this out. Instead of 100 shares risking $4.70 each, you could get 200 shares and 2 contracts. You'd still be risking $4.70 each, but it would end up being a total of 6.7%, but a total of $9.40. How does this change things for you? Well, we already did this poll, so I'm just going to revisit the results. Okay. How does this change things for you? We said, if you limited risk like what we showed, 6% of the trade and 1% of your capital, what would it have done? Nobody said that they would have done worse or had no change, and a lot of folks said, you know what, even with the bad picks I had last year, it would have saved me some money. 39% said I lost overall last year, but it would have changed it to wins, and 30% said I would have said I'm happy with my trading results, whereas before, only 10% had said that. Only 10% said I'm happy with my trading results. I've exceeded expectations. Okay, so let me hide that. Here's the Mary Put graph. Now, briefly, Mike, what is this red line all about? The blue line is expiration.
Yeah, that's where, we see that argument where we can't make a dime until the stock's up at 69.70. Yes, that's assuming we hold it all the way to expiration and make no adjustments. The stock would need to be at 69.70 to be at break even. The curved red line is showing us the profit and loss at the halfway point, halfway between now and expiration. What would the theoretical profit and loss of this position be based on the Black-Scholes pricing model if the stock was trading at these prices? And here we see that right around maybe $66, $66.50, we'd be at break even on June 14th, 2011, the halfway point between when you open the trade and the expiration date.
Right, and looking at your trade again on that date, you might say, okay, maybe I should make an adjustment. Maybe I shouldn't do this, and so you could get out and not lose 6.7%, but rather lose, 3% or 4%. Okay, so that's the idea. Okay, now when that's in place, let's go to this is actually from another presentation where I talked about a poker table, okay? So with that in place, we're going to show how to rob the market maker of his edge. We're going to rob the market maker of his edge. Here are the players. There's a cover call seller sitting at this table. There's call buyers sitting at this table. There's bull call spreaders, and there's the market maker, and finally, me. And all these folks are bantering back and forth, selling calls, buying calls, looking at different strikes and so forth. Let's look at the April calls. Now remember, we've got our stock protected clear out to August, but we're playing the April calls for this example. Okay. Now, folks that are doing just cover calls, this example might be a little over your head, but some folks doing spread trades, you'll get this right away. Okay. We're selling the April 67.50s for 95 cents and buying the April 70s for 45 cents. Mike, what's that going to do for us, and what's that called?
Okay, well, first it does look partially like a covered call. We are selling a 67.5 call, but then we're buying a higher strike call, and this creates a bear call credit spread. If we use the natural prices, we're going to sell the 67.5 for 95, buy the 70 for 45. This results in a 50-cent net credit. This would give us the same risk-reward profile we saw on that spread trade earlier that you pulled up. It was this trade, as a matter of fact. There it is. So we get 50 cents per contract, and if you're trading 2 contracts, that would result in a premium into your account of $100. This trade, by itself, the bear call spread, has that 4-to-1, 5-to-1, sometimes 10-to-1 risk-reward ratio. If the stock goes above 70, then you're going to be forced to deliver shares of stock you don't own at 67.5. You would have the right to buy them at 70, so you take that $2.50 loss between the strike prices. For 2 contracts, that'd be $500. But thankfully, you still keep that $100 net credit, so it'll only be a loss of $400 or 100% of the risk on the position.
I think I heard your fingers making quotation marks when you said only.
Yes, it's only.
You only lose 400, or yeah. So it's you're going to take in $100 to do this, but you have the potential, if you only do the bear call spread itself, you have the potential of having to pay back $500. So you have a $400 loss. Well, guess what? Credit spreaders, you're going to dig this. This risk-reward graph shows 2 bear call spreads generating 50 cents credit each, but leaving $2.50 at risk. Well, let's talk about doing it in the context of our married put. You see, our married put, our radioactive profit machine, had 940 at risk. Remember that from a few slides ago there, Mike?
Yes.
Where we had the let me just go ahead and go back to that. Ready, set, boom, right here. $940 is the real dollar risk in this about $14,000 investment. We bought the stock. We bought the put options.
Yeah, okay. 200 shares and 2 puts, so $470 at risk, or $940 for 200 shares and 2 put contracts for the Humana position.
Very good. Okay, so after we've done that, now we've got $940 at risk in the radioactive profit machine, and its duration is until August. All right? Now, the income method number 6, bear call spread, times 2 contracts has a $400 risk. So if we add these 2 together, if we buy stock, buy puts, sell a call, buy calls, what do we end up with for risk? We've got $940 risk here, $400 risk here. What happens now?
Well, what we're looking at here is you might think that the risk is going to be $1,340, but that's not the way the position works.
Right, it doesn't. What's going to happen is owning stock takes all the risk out of this income method number 6 play. Because what's risky about doing a bear call spread is you sell a call at a low strike price, and if the stock goes up, you've got to buy it at a higher strike price to deliver it.
You lose the difference in the strikes.
Yeah, but guess what? We own it. If we own the stock, we can't get hurt. Okay, so owning stock, the ownership of stock, takes away this 400 risk. Okay, and that doesn't mean that 940 is left, because doing the income method number 6 generates $100. Now we have 840 at risk. Isn't that something? Both of these trades pull away from the risk of each other. Instead of 1340 risk, you end up with 840 risk. It's kind of cool. So that bear call spread method takes away 100% of the, I'm sorry, not 100%, $100 of the risk in the Mary put. Eventually it will be 100% when we bulletproof ourselves. Okay? The ownership of stock takes away all the risk from the bear call spread. So this is what the chart actually looks like. Mike, if the stock goes up and my bear call spread goes against me, yeah, it goes against me, but that's kind of offset by the fact that my stock went up. And here's another thing. I may have to deliver my stock at 67.50.
Right.
And my put option may be losing value as the stock goes up. But as that happens, hey, I've been paid to own 2 long calls. Let me say that again. I've been paid to own 2 long calls. This is kind of exciting because the maximum profit is still infinite. There's an unlimited upside potential. I'm taking a credit, and I've still got unlimited upside potential. The bear call spread goes against me, so what? I still win. And 2 of those calls are going to be in the money if it goes up high enough, it goes up above 70. Kind of cool. So, again, I asked, whoops, wrong one. I shared the wrong one. I asked, what do you think of spread trades that take income, risk nothing if they go against, and leave the upside open? Well, again, I've showed you 2, and we're just about out of time. We've got 2 minutes left. I want to explain something. The edge of the market maker is usually 10 or 20 cents wide, right? Where they
the bid-ask spread that we saw before, yeah.
Yeah, where they're bidding at one price and asking another. But let me ask you this, Mike. If I took a 50-cent credit per share by doing this bear call spread, doesn't that take away the edge from the market maker?
Yes, it does, because you still have the unlimited upside risk. You don't have to necessarily pay anything back to close a position as the stock continues to move up.
Right. I think you meant unlimited upside potential, right? We still have unlimited upside potential.
That's what I meant to say.
Right. And yet, this is like, sometimes you hear those things that sound too good to be true, like a government loan that you never have to pay back. Well, this is like a loan that if you have to pay it back, you have the money to pay it. For you to have to pay back that 50 cents, the stock has to go up by more than 50 cents, and it's okay. It's all right. Okay, so this is what we showed. We showed why married puts, the reactive way, are superior to cover calls and credit spreads. We showed how married puts can help you with your trading. Okay, in fact, the
poll answered that itself.
Yeah, the poll results really showed that. We showed you how to take the biggest objection out of the way. The biggest objection is, well, I don't like spending money on the put option. Well, guess what? We showed how using that put option you could actually generate credit. Okay? So here's the question. What are you going to do next? What are you going to do next? Well, what do you think you ought to do? Mike, this is a good time for me to show how to pick up the blueprints, and I'm going to do that.
Okay.
I'm going to go over to, whoops.
Yeah, and let me just, sorry, I was just going to say, Kurt, now a lot of you may be looking at that position, the one we just showed with the income method number 6, and you saw that limited upside. You might say, oh, well, if my expectation was the stock was going to go up to $75 or $80 and really take off, wouldn't I have been better just staying in the married put? You might have been, but that's what the blueprint's about. The blueprint teaches you not only what we look for with that initial setup and what Kurt uses for his stock selection, but you can really use any stock selection process with this. Excuse me, but it also discusses the 11 different income methods that are used. Once you've created that, why you would use them and what situations to look for. We use what's called the SIGA model, Kurt, to decide which income method best suits our goals and our expectations.
Right. The SIGA model, conditions, expectation, goals, and actions, make it so that this form of trading actually becomes an overlay onto what you already do. If you already have stocks that you're familiar with trading, well, stick with it. Just make sure that you don't get hurt when you're wrong and you make more when you're right. If you've already got a technical trading system that you're used to of when to get in and when to get out, great. But overlay onto that the possibility of taking income out of your stock without necessarily selling it, using these riskless spread trades. It's kind of cool. Mike, I'm putting up the offer for Radioactive Trading Home Study Kit. It's $5.99. A lot of folks have spent more than that on other materials and so forth. But what I wanted to do was mention that, first of all, the $5.99 is much less than what I had to spend in order to get my education on just one method, which was covered calls trading. I had to spend over $3,000 in a weekend. And then the market gave me an even more expensive education.
Unfortunately. But that's common.
Unfortunately. Yeah. So this is about a fifth of that. This is about 20% of the $3,000 that many of us spent on a covered calls weekend training. What the Radioactive Trading Home Study Kit is 6 CDs that explain all 11 income methods, right? It's the Blueprint, which is the book I wrote back in 2002, and which has not been proven wrong since, okay? And the Blueprint is for reference. But what also comes with this is support. At any time you write to us with questions about your particular situation, and we're not going to make recommendations because we're not licensed brokers.
Mm-hmm.
All right, I'm not a make-you broker, but what we can do is look at your situation. I was able to look at a friend's situation, a fellow that owned 1,600 shares of Starbucks, and I said, man, how would you like to take all the risk out of that? I showed him how he could get paid to have put options. He actually got paid to have an insurance policy on his stock, and his support with his purchase of the Blueprint has been worth it many times over, thousands and thousands of dollars over.
And we also had a gentleman, of course, Ernie told you about that recently, the gentleman with Apple that had the unrealized gain and didn't want to sell the shares for tax consequences, actually. And he was able to lock in profit with the puts and then use one of the income methods to keep ratcheting that up as the stock went up to 700. But guess what? When it collapsed and it was trading back down near 500 in the past 30 days or so, many investors who had purchased around 690, 680 were down $100, down 120, down $130. He had it locked in. His put was valued over $40,000, and he still had the low cost basis he originally had on the stock.
Wow. Yeah, that's pretty fabulous. We should ask Ernie about having that guy come on one of our webinars, or at least sharing the details. We don't have to share his name, but at least sharing the details of how his decision to pick up the Blueprint meant tens of thousands of dollars.
Mm-hmm.
So, folks, here's the deal. I can't guarantee you that you're going to have an experience like Mike or I have, an experience like the fellow that owned Apple, an experience like Steve, the guy that owned the shares of Starbucks, and he bulletproofed it and got paid to do it. I can't guarantee that, but what I can guarantee is a refund on the Blueprint. A refund on the Home Study Kit. If it doesn't do for you what you think it's going to do for you, send her back. But in the meantime, don't let this opportunity go by. This is could be the answer that you've been looking for, and according to the polls, it is. According to the polls, we had 100% answer that they would have been better off if they just employed the thing that I showed you for free today.
Yeah, without the income methods, just limiting the risk to 6% on their positions.
Right. Mike, I'm doing just kind of an exit poll here, and we're done with the presentation today, but I thought I would just ask folks that are still here, and we still got more than 50 of you, I'd like to ask if, just tell me, what do you think is the most valuable thing to you? The most valuable thing to you of today's lesson, was it limiting risk down to single digits with something way better than a stop order? Or was it seeing how the put could be moved to guarantee a payout? That's what I used with income method number 3.
Which you can't do with a stop order.
You can't do that with a stop order. Was it seeing how a spread trade could take income and leave the top off?
Without carrying the leverage risk that's normally seen with a bear call credit spread, for example.
That's right. Was it the structure of the trade being more important than the trade itself, being more important than your criteria for getting in, or your your fundamental analysis?
Timing.
What's more important is your timing, or your it's more important to structure a trade properly. Or was it bulletproofing? Was it the notion that you could actually take out all the risks in the ownership of stock? Doesn't happen every time, but it can happen, and I show how it can happen. Okay, let's go ahead and close that poll, and I'll share the results now. Hey, it ended up even tens here. 10% limiting risk to single digits, 30% structure of a trade is more important than the trade itself, and 60% said bulletproofing. Very cool.
And you know what's even a reflection on that, what's powerful about bulletproofing as well is, Kurt, we've had investors come onto our webinars, 3 or 4 years ago when we first started doing these twice weekly webinars, and a couple customers were saying, oh, well, this is nothing special. I'm bulletproof on my shares of Citigroup or Ford, and I've been trading them for years now, but I've bulletproofed them with covered calls. I say, oh, that's fantastic. How long did that take? Oh, 8 years, 7 years.
Right.
Lower the cost base in 8 or 7 years. The trade you showed today was bulletproof within a 30-day time period. Yeah,
it was bulletproof in actually, yeah, it was 30 days to the day.
And the upside was always open.
Yep. Mike, I've just sent out 2 links, one to radioactivetraining.com, and you'll want to go to the, am I still sharing the poll results? Maybe.
Yes, sir. Yes, sir.
Yeah, maybe fix that. Okay. So now, are we showing the screen again?
No, you're still sharing the poll results. Let me do this. Let me hide that.
Oh, it actually went bye-bye.
There you go. Now you're back on your screen, sir.
Thanks for doing that. Okay, so folks, the Radioactive Trading Home Study Kit, $5.99. It's guaranteed. Also comes with a free month of power options and a consultation with me or Mike. If you want to go a little cheaper, you can certainly pick up just the blueprint. The blueprint is $3.39. Doesn't have the CDs, but it does have all the information that I've spoken about. And if you pick it up today, we will include one of the 6 CDs, the Foundations of Radioactive Trading CD that talks about all the income methods and the principle behind them, what makes it work.
Mm-hmm.
And very cool. Okay. Mike, have any questions come in that we should handle, or should we forward that?
No, most of it was just related to a lot of the questions I had in the past little while. We did have a discussion earlier on, but that was answered by the presentation regarding the 1% of the portfolio at risk and the 6%. We cleared that up a little bit, and then you did it again. But here, just where Kurt's showing, you see radioactivetrading.com, there's that tab there for free webinars. Those of you that came in late, those of you that missed some of the presentation, you can view the webinars at any time, the archives at any time, I should say, and we'll hope to have this one up sometime later this afternoon.
Very good. Just so you all know, that is going to go away soon. We've got lots and lots of free information up here. It's going to go away. We give it away a lot, and this page is going to very soon probably just offer 1 or 2 recordings.
Yeah, so I'm probably going to, I can tell you today, we're probably going to take out how to take the risk out of spread trades, and we'll replace today's with that one most likely. Or replace that one with today's, my apologies. A couple of the other ones down there at the bottom we might be removing as well. So.
Okay. And so, yeah, Radioactive Trading Home Study Kit, 100% money-back guarantee. The guarantee also applies to the blueprint. Blueprint's the same material, only no multimedia. There's no there's no me and Mike talking to you. And you're looking at a dynamic presentation on your screen. The blueprint's simply a book.
Mm-hmm.
But both products are 100% guaranteed and come with 3 months of power options. Some other bonuses that we're not even going to talk about right now. Just say, hey, look, pick up the blueprint. Pick up the blueprint. Pick up the home study kit if you want a fuller, quicker route to success. And I wish you happy trading.
All right, we'll see you again Thursday at 12 noon Eastern Time. If you have any questions, remember, go ahead and send us an email to support at radioactivetrading.com. And you'll also be asked if you have any questions at the end of the presentation. You'll see a menu come up when you exit the webinar saying if you have any questions after the presentation, send it to us, and I'll get back to you later on this afternoon as well.
Very good. All right, there, Mike. I'll talk to you in 2 days.
All right. Take care, everyone.